There is a market worth over $130 trillion. It is the single largest financial market on the planet, and it directly impacts the interest rate on your mortgage, the availability of your job, the performance of your stock portfolios, and even the price of crypto. And it has accurately predicted nearly every major recession of the last 50 years, long before the other markets even knew what was coming. And no, it's not the stock market. It's not the crypto. It is the bond market, and it is the hidden operating system for the entire global economy. Despite all this, the vast majority of people have no idea how this system works. We are about to fix it, because if you don't understand bonds, you don't understand money. To understand the system, we must begin with its most fundamental component. So what exactly is a bond? Forget the complex jargon for a moment. In the simplest possible terms, a bond is a loan. It is nothing more than a formal, tradable IOU. It is a contract between two parties, a lender, who provides the capital, and a borrower, who receives the capital and promises to pay it back. Let's use a hypothetical example. Imagine a company wants to build a new factory to expand its business. The cost is $10 million. The company decides to borrow this money by issuing bonds. They create 10,000 individual bonds, each with a face value of $1,000. You, as an investor, buy one of those bonds. You have now lent the company $1,000. This initial amount, the face value of the loan, is called the principal. In exchange for your loan, the company promises to pay you a fixed interest rate. Let's say it's 5% per year. This means you will receive $50 every year. This annual interest payment is called the coupon. Finally, the contract specifies when the loan is due. Let's say it's a 10-year bond. At the end of 10 years, the company must pay you back your original $1,000 principal. This end date is the bond's maturity: principal, coupon, and maturity. Those are the three simple components of a bond. But there is one more crucial concept you must understand: yield. The coupon rate is fixed. In our example, it's always $50 per year, but the price of the bond itself is not fixed. After it's first issued, a bond can be bought and sold on a secondary market, just like a stock. The yield is the actual return you get on your investment, based on the price you paid for the bond. And this leads to the single most important rule of the bond market. Bond prices and bond yields have an inverse relationship. When the price of a bond goes down, its yield goes up. Think about it. The bond still pays its fixed $50 coupon. If you are able to buy that bond for a discounted price, say $900, you are still receiving the same $50 in interest. A $50 return on a $900 investment is a yield of 5.5%. The price went down, so the yield for the new buyer went up. Conversely, when the price of a bond goes up, its yield goes down. If you buy that same bond for $1,100, you are still only getting the $50 coupon. A $50 return on a $1,100 investment is a yield of just 4.5%. This inverse relationship is the absolute, non-negotiable foundation of the entire bond market. So we know a bond is a loan, but who are the biggest borrowers in this $130 trillion market, and why do they need so much capital? The first and most significant borrowers on the planet are governments. Every year, governments collect a certain amount of money, primarily through taxes. We can call this their income. But they also have massive expenses, funding everything from public services and infrastructure to social security and national defense. In most years, for most major countries, the spending bar is significantly taller than the revenue bar. This gap is called the budget deficit. To fill this gap and pay its bills, the government must borrow money. It does this by issuing bonds to the public. For a country like the United States, these are known as Treasury bonds. Each year's deficit adds to the country's total pile of debt. As of late 2025, the U.S. national debt has surpassed $38 trillion. This is not an opinion. It is a simple, verifiable fact from the U.S. Treasury itself. But governments are not the only major players in this system. The second group is corporations. A successful company often needs large amounts of capital to grow, to build a new factory, to invest in research and development, or to expand into new markets. To raise that capital may have two primary options. First, they can sell ownership in the company by issuing stock. This means giving up a piece of the company and its future profits to shareholders. It is an effective but dilutive way to raise money. The second option is to borrow the money by issuing corporate bonds. This is a form of debt. By choosing to issue bonds, the company's owners get the capital they need without having to give up any ownership or control of their enterprise. They simply promise to pay the money back, with interest. These two groups, governments needing to fund their operations and corporations needing to fund their growth, are the largest issuers of debt. creating the massive supply side of the bond market. So if governments and corporations are the biggest borrowers, who is on the other side of this $130 trillion trade? Who is lending all of this capital? The answer is not primarily small individual investors. The demand side of the bond market is dominated by the largest, most conservative pools of capital on Earth. First, you have commercial banks. They need a safe, liquid place to park their capital to meet regulatory requirements and ensure they can always meet customer withdrawal demands. Second, and even larger, are pension funds. A pension fund has a simple mandate: take in contributions today and provide a reliable income for retirees, sometimes 30 or 40 years in the future. They cannot gamble with that capital. They need assets that provide a predictable, long-term stream of income that matches their long-term promises. Bonds are engineered for this exact purpose. The same logic applies to insurance companies. They collect billions in premiums today for disasters, or claims that might not happen for years. They must invest that float in something incredibly safe. And finally, you have foreign governments and central banks. They hold trillions of US dollars in their foreign exchange reserves to facilitate international trade. They need a safe, dollar-denominated asset to store that value. This brings us to the single most important concept in this chapter: the idea of a risk-free asset. And the US Treasury bond is considered the benchmark for the entire world. Why is it considered risk-free? Because the risk on a bond is primarily credit risk, the chance the borrower will not be able to pay you back. A corporation, no matter how large, could theoretically go bankrupt. But the US government has two unique powers that a corporation does not. First, it has the power to tax the largest and most dynamic economy in the world. And second, it has the exclusive authority to print the very currency that its debts are owed in. Because it can literally create the money to pay its debts, the risk of a direct default is considered by the global market to be virtually zero. This is why the yield on a US Treasury bond is called the risk-free rate of return. It is the baseline. It is the yardstick. The expected return of every other investment on the planet, from the riskiest stock to the safest corporate bond, is measured from this starting point. The additional return an investor expects for taking on additional risk is called the risk premium. If the risk-free rate is 4%, a rational investor would never buy a risky stock unless they expected to earn significantly more than 4%. The risk-free rate, set by the bond market, provides the gravitational pull for the entire universe of asset prices. This global, structural, and unending hunt for the ultimate safe asset creates the enormous demand side of the bond market. And with that, the cycle is complete. On one side, you have massive borrowers, governments and corporations, creating the supply of bonds. On the other side, you have massive lenders, banks, funds, and institutions, creating the demand for those same bonds in their search for safety. This massive, constant tension between supply and demand, between borrowers needing capital and lenders needing safety, is what sets the price of money itself across the entire globe. It is the invisible engine that powers everything. And now that we understand how the machine is built, it's time to learn how to read its signals. Now that we understand the players and the pieces of this invisible engine, we can learn how to read the game it is playing. Because the bond market isn't just a system for borrowing, it's a living, breathing, collective intelligence, a powerful signaling mechanism that tells us the truth about the health of the economy. The most powerful and historically accurate signal this market generates is something called the yield curve. And while it sounds complex, it's built on a foundation of pure common sense. Let's ask a simple question. If you were lending your own money, would you demand a higher interest rate for a loan that gets paid back in 3 months, or one that gets paid back in 30 years? The answer is obvious. You would demand a much higher rate for the 30-year loan. There is far more time for things to go wrong, for inflation to rise, for the borrower to face trouble, for the entire economy to change. More time equals more risk. And for taking on more risk, investors must be compensated with a higher potential return. This natural state of affairs, where long-term bonds have higher yields than short-term bonds, creates what we call a normal yield curve. It's a sign of a healthy, functioning economy, where investors expect normal growth and stability in the future. But every so often, a strange and deeply unnatural phenomenon occurs. The bond market becomes more afraid of the immediate future than it is of the distant future. In these rare moments, investors become so worried about an imminent economic slowdown that they all rush to lock in today's long-term yields, which they believe are higher than what will be offered in the near future. This massive demand for long-term bonds pushes their prices up, which, as we know, causes their yields to go down. At the same time, the mass selling of short-term bonds causes their yields to spike. The result is an inverted yield curve. This is not just a statistical anomaly. It is the bond market's equivalent of a fire alarm, screaming a warning that the world's most sophisticated investors expect an economic slowdown. A recession is on the horizon. This isn't just a theory, it is one of the most reliable historical indicators in all of finance. According to data from the Federal Reserve itself, this signal has appeared before every single US recession for the past 50 years. Let's look at two critical examples. First, the dot-com bubble. Historical data shows the yield curve inverted in early 2000. At the time, the stock market was euphoric, with tech stocks hitting unbelievable new highs. But the bond market was quietly signaling a disaster. Shortly after the inversion, the technology-heavy stock market completely collapsed, wiping out trillions in wealth. Now let's look at the second, even larger example, the 2008 global financial crisis. Throughout 2007, while news headlines were still optimistic and the stock market was pushing to new all-time highs, the bond market was screaming a warning. The yield curve was inverted. The bond market saw the immense risk building up in the housing market and was signaling a major crisis. Less than a year later, the global financial system imploded. This is the power of the yield curve. It is not a mystical crystal ball. It is the collective, data-driven consensus of the most risk-averse capital in the world, and it has proven to be an astonishingly prescient indicator of economic trouble. The yield curve is an incredible tool for seeing what the market expects in the future. But the bond market also gives us a vital, real-time gauge for measuring fear in the system, right now in this very moment. This tool is called the spread, specifically the credit spread, and it operates on a very simple principle. Not all bonds are created equal. As we've established, a US Treasury bond is considered the safest asset in the world. But a corporate bond, issued by a company like Ford or Apple, always carries a degree of risk. That risk is called credit risk, or default risk. It's the simple, real-world possibility that the company could fail and be unable to pay you back. To convince an investor to take on that extra risk, a corporate bond must offer a higher yield than a treasury bond of the same maturity. It has to offer a better return to make the risk worthwhile. The difference between these two yields is the credit spread. It is the market's price for taking on corporate risk. Now here is where it becomes a real-time fear gauge. During normal, stable economic times, investors are confident. They believe companies are healthy and the risk of default is low. In this environment, they are willing to accept a smaller reward for taking on corporate risk. The credit spread is narrow and stable. But when investors start to worry, when they see signs of an economic slowdown, their perception of risk changes instantly. Suddenly, the risk of a company defaulting seems much higher. Investors begin to sell their riskier corporate bonds in a, quote, flight to safety. They take that capital and pour it into the safest place they can find, government bonds. This has two immediate effects. The massive selling of corporate bonds causes their prices to fall, which means their yields spike upwards. Simultaneously, the massive buying of government bonds causes their prices to rise, which means their yields fall. When the risky yield is spiking upwards and the safe yield is moving downwards, the difference between them, the spread, explodes. This is known as a widening spread. A widening credit spread is a real-time indicator of increasing fear and stress in the financial system. Let's look at the data. During the dot-com bust of 2001, as technology companies began to fail, the high-yield spread more than doubled, signaling widespread corporate distress. During the 2008 financial crisis, the signal was even more extreme. The spread exploded to levels not seen in generations. It was the market's heart monitor going into cardiac arrest. More recently, during the initial COVID-19 panic in March of 2020, the spread spiked dramatically in just a few weeks, as the world braced for a complete economic shutdown. So why does this matter to you, even if you don't own a single bond? Because this spread directly affects the real economy. When the credit spread widens, it means the cost of borrowing for all corporations is going up, not just for the riskiest ones. And when it costs more for companies to borrow, they do less of it. They cancel new projects. They delay building that new factory. And they put a freeze on hiring. A widening credit spread is often a leading indicator for rising unemployment. It is the transmission mechanism for financial pain to flow from Wall Street to the real economy where people live and work. And that is the second critical signal the bond market provides us. Think of it this way. The yield curve is your long-range forecast. It warns you of a potential storm on the distant horizon. The credit spread, on the other hand, is your real-time barometer. It tells you the atmospheric pressure is dropping, right now. Together, these two signals form a powerful, data-driven dashboard for reading the true state of the economy. It's a dashboard that is completely free from the noise of daily headlines and the distracting opinions of so-called experts. Understanding these signals is the first step in a profound transformation. It is the step you take to move from being a passive passenger, tossed around by the volatility of the markets, to becoming a navigator, using the data to understand the environment and steer a deliberate course. You become capable of seeing the financial weather for what it is, not for what others tell you it is. So the bond market serves as a global warning system, a dashboard for economic health. But its most important function is not simply to signal power, but to project it. And in this global game of money and influence, one asset sits on the throne: the US Treasury bond. It is not just another IOU. It is the single most important financial instrument in the world, serving as the bedrock of the entire system. The reason for this dominance comes down to a single word: collateral. In the high-stakes world of global finance, trust is a rare commodity. When a major bank needs to lend another bank $1 billion overnight, it doesn't do so on a handshake. The lending bank requires the borrowing bank to pledge an asset as security. If the borrower fails to repay the loan, the lender keeps the asset. That asset is the collateral. And in the global financial system, the best, most liquid, and most universally accepted form of collateral is a US Treasury bond. This isn't just theory. Trillions of dollars in transactions, from overnight loans to complex derivatives contracts, are secured every single day using treasuries as the financial bedrock. This creates a constant, structural demand for US government debt from every corner of the globe, as institutions need to hold treasuries to participate in the global market. And here is the crucial connection. To buy a US Treasury bond, you must first acquire US dollars. Therefore, the world's unending need for a safe asset creates a permanent, structural, global demand for the US dollar itself. This is the heart of what is known as America's exorbitant privilege. By controlling the world's most sought-after safe asset, the US also benefits from the world's need for its currency. This allows the United States to do something no other country can do on a same scale: run massive budget deficits and fund them by borrowing money at lower interest rates than would otherwise be possible. It is a self-reinforcing loop. The world's instability and search for safety drives capital into US bonds, which strengthens the dollar and allows the US to project economic power, further reinforcing the system. This is the core of the power game. The US Treasury bond is not merely a financial tool. It is a primary instrument of geopolitical and economic influence. Understanding this is fundamental to understanding the modern world. This global system, built on the foundation of the US Treasury bond, is not left to chance. It is actively managed, and the managers are the world's central banks. In the United States, this is the Federal Reserve. And while its mandate is complex, to maintain price stability and maximum employment, its primary tool of influence is brutally simple. It sets the interest rate for the shortest loan term imaginable: a single night. This is the rate at which commercial banks lend to each other overnight to meet their daily reserve requirements. This rate is known as the federal funds rate. It is the most fundamental cost of money in the entire economy, and it acts like the first domino in a massive, global chain reaction. When the Fed raises or lowers this one single rate, it sends a powerful ripple through the entire bond market, affecting the yields on all other bonds. Here's how. The yield on a 2-year bond is essentially the market's expectation of what the federal funds rate will average over the next 2 years, plus a small premium for risk. The yield on a 10-year bond reflects the market's expectation for that same rate over the next 10 years. So when the Fed signals that it intends to keep rates higher for longer, the yields on bonds across all maturities must adjust upwards to reflect that new reality. Central banks, therefore, do not directly control the economy. They don't set your mortgage rate. They simply control the anchor point and let the bond market do the heavy lifting of transmitting that policy to the rest of the system. This transmission mechanism is the critical link between high-level policy and your personal finances. When the Fed raises its rate, banks have to pay more for their own short-term borrowing. To maintain their profits, they pass that increased cost directly on to their customers. The interest rate on a new car loan goes up. The rate on a new mortgage goes up. The rate a small business has to pay to get a loan for a new piece of equipment goes up. This is the system at work. A decision made in a boardroom in Washington, D.C. is transmitted through the bond market and directly impacts the financial decisions of millions of people and businesses. This gives central banks immense power. By raising rates, they can intentionally slow down the economy to fight inflation. By lowering rates, they can encourage borrowing and spending to fight a recession. This is the awesome and terrifying power of the central bank's lever. Central bankers are, in effect, the engineers of the economic cycle, constantly trying to fine-tune this massive, complex machine. And their primary interface, their main control panel for this entire system, is the bond market. Their decisions create the financial weather that everyone else must navigate. As the ripple spreads, we see the real-world impact. The speed of the machine's gears suddenly begins to change. They are not all-powerful. They too are reacting to the data on inflation and employment that the machine feeds back to them. But their reaction, amplified by the $130 trillion bond market, becomes the dominant force shaping our economic reality. Whether they are successful in their goals of creating stability is a matter of intense and constant debate. But what is not up for debate is the mechanism they use. They do not directly command the economy. Instead, they influence the bond market. In the bond market, this silent, invisible engine does the rest. So the bond market is not just a market. It's the chessboard on which the game of global finance is played. It is the language of power, of risk, and of the future. By understanding its rules, the yield curve, the spreads, the flow of debt, you stop being a passenger reacting to the news. And you start becoming a player who sees what's coming. You learn to read the silent system. If you want to go even deeper into how these hidden systems are used to build and protect wealth over the long term, I've compiled my most powerful frameworks into my book, The Silent System. It is the blueprint for understanding and implementing this very system in your own life, moving from a consumer to a capital allocator. You can find it on Amazon by scanning the QR code on your screen now, or by using the link in the description below. The next time you hear a politician talk about the national debt, or a news anchor obsess over the daily movements of the stock market, remember what you learned today. Remember to look deeper, look past the noise, and search for the signal. Look at the bond market, because that is where the truth is. This knowledge doesn't require you to act every day. It requires you to understand every day. It is the foundation of strategic patience. Since you've made it to the end of this deep dive, it's clear you have a genuine interest in understanding how the financial system truly works. For your next step, I highly recommend the videos now appearing on your screen. They build on these foundational concepts and will further sharpen your analytical edge, helping you to build your own framework for financial resilience. If this video provided you with a new framework for thinking, the most valuable thing you can do is like and subscribe so you never miss another strategic briefing. Thank you for watching.